Gold just did something it hasn't done in 43 years. And almost nobody is talking about it. While everyone's debating whether gold hits $3,000 or $4,000, they're missing the real story. The unthinkable scenario that's forming right in front of us. A scenario where gold doesn't just rise, it completely disconnects from the system we've known for half a century. What if I told you that gold could spike to levels that would make today's prices look like pocket change? Not because of inflation, not because of war, but because of something far more structural, something that's already started. Right now, you're watching gold hover near all-time highs, while the Federal Reserve is supposedly fighting inflation. That shouldn't be happening. Gold is supposed to fall when real rates rise. It's supposed to struggle when the dollar strengthens. But here we are. Gold is ignoring every traditional signal. And this is where most people get confused. They see gold rising and think it's just another inflation trade. They think it's about the national debt or geopolitical tensions. But that's only the surface explanation. The real mechanism is far more disturbing. What you're witnessing is the early stage of a monetary reset that central banks have been quietly preparing for since 2008. And once you understand what's actually happening, you'll realize why gold's next move could be the most violent repricing we've ever seen. Let me explain what's really going on here. For decades, gold moved in predictable patterns. When the dollar weakened, gold strengthened. When real interest rates fell, gold rose. Simple correlations that every trader could follow. But something broke in 2022. Gold started rising alongside the dollar. Think about that. The dollar index shot up to 20-year highs, and gold kept climbing. Real rates went positive for the first time in years, and gold kept climbing. The Fed hiked rates at the fastest pace since Volcker, and gold kept climbing. This isn't normal market behavior. This is what happens when the underlying trust in the system starts to crack. Here's what most people miss. Central banks have been the largest buyers of gold since 2010, but the pace accelerated dramatically after Russia's reserves were frozen in 2022. Last year alone, central banks bought over 1,000 tons of gold, the highest level since 1967. Why would central banks be hoarding gold while telling you the economy is fine? Step 1 in understanding this mechanism. Central banks know something you don't. They see the math. Global debt now exceeds $315 trillion. That's over 300% of global GDP. There's no way to pay this back without destroying currencies. Step 2. The freezing of Russia's reserves sent a shockwave through every central bank on Earth. If the US can weaponize the dollar and freeze reserves, then holding dollars isn't safe anymore. This wasn't just about Russia. It was about the fundamental trust that underpins the entire monetary system. Step 3. And this is where everything changes. Central banks are now racing to accumulate real assets before the reset happens. They're not buying gold because they think it'll go up 20%. They're buying gold because they know paper currencies are entering their final phase. History shows this pattern again and again. In 1933, Roosevelt confiscated gold and immediately revalued it from $20 to $35 per ounce. Overnight. A 75% devaluation of the dollar. Why? Because the debt had become unsustainable. In 1971, Nixon closed the gold window when foreign central banks tried to convert their dollars to gold. The system was breaking. Gold went from $35 to $800 in less than a decade, a 23-fold increase. In 2008, central banks printed more money in 6 months than in the previous century combined. Gold went from $700 to $1,900. And that was just quantitative easing. Child's play compared to what's coming. But here's why this time feels different. This time, we have convergence. Every major economy is drowning in debt simultaneously. The US national debt exceeds $34 trillion. Japan's debt to GDP is over 260%. Europe is fragmenting. China's property bubble is imploding. There's nowhere to hide in paper currencies. Meanwhile, the physical gold market is showing stress fractures everywhere. The COMEX Gold Warehouse has seen deliveries spike to record levels. The London Bullion Market Association admits that physical supply is tight. Premiums on physical gold are rising even as paper gold prices consolidate. And then there's the supply problem nobody talks about. Gold production peaked in 2018. Despite gold prices doubling, miners can't increase production. The easy gold has been mined. What's left requires more energy, more capital, more time. At exactly the moment when demand is exploding. Think about the mathematics here. If central banks continue buying at current rates, they'll absorb nearly half of annual mine production. Add investment demand, jewelry demand, and industrial use, and you have a recipe for a supply squeeze unlike anything we've seen. But that's not even the biggest catalyst. The real shock will come when one major economy announces a partial gold backing for their currency. And this is where the unthinkable happens. Because once one country moves, they all have to move. It's game theory at its purest. China has been preparing for this for over a decade. They've accumulated thousands of tons of gold, though they'll never tell you the real number. They've built the Shanghai Gold Exchange to rival London. They've created the digital yuan to bypass SWIFT. Every piece is in place. Russia has more gold relative to their money supply than any major economy. They're now settling international trade in gold. Not dollars, not euros, physical gold. Even Texas has built its own gold depository and passed laws to create a gold-backed currency if needed. Texas, not some fringe nation. The 9th largest economy in the world is preparing for a gold standard. When this transition begins, and it's not a matter of if, but when, gold won't rise in a straight line. It'll gap higher overnight. Just like in 1933, just like when Switzerland depegged from the euro. Massive, violent repricing that happens in hours, not years. The mechanism will work like this. Phase 1, which we're in now. Central banks quietly accumulate while keeping prices suppressed through paper markets. Smart money notices the divergence and starts positioning. Phase 2 begins when physical demand overwhelms the paper suppression. Premiums explode. Delivery delays extend. The facade cracks. This could happen any month now. The signs are already visible if you know where to look. Phase 3 is the repricing. One morning you'll wake up and gold will be limit up, trading halted. When it reopens, it'll be thousands of dollars higher. The window to position will have closed. Forever. And Phase 4? That's the new monetary system. Where gold isn't priced in dollars anymore, where dollars are priced in gold. A complete inversion of the last 50 years. The indicators you need to watch are crystal clear. First, the gold-to-oil ratio. When gold starts rising faster than oil consistently, it signals monetary fear overtaking commodity inflation. We're seeing this now. Second, central bank buying patterns. When monthly purchases exceed 100 tons consistently, the accumulation phase is accelerating. We crossed this threshold 6 months ago. Third, COMEX registered inventories. When these fall below historical averages while open interest rises, the paper market is stretching. Current levels are the lowest in years. Fourth, yield curve control announcements. The moment any G7 nation formally announces yield curve control, that's your signal that the endgame has begun. Japan's already there. Who's next? Most investors think they have time. They think gold moving from 2,000 to 2,500 is the big move. But that's thinking too small. Way too small. When the London gold pool collapsed in 1968, gold moved from $35 to $200 in 3 years. When Bretton Woods ended in 1971, gold moved from $40 to $850. Each time the monetary system broke, gold didn't just rise, it exploded higher by multiples that seemed impossible until they happened. Today's setup is bigger than both those events combined. The amount of debt is unprecedented. The currency debasement is unprecedented. The central bank coordination is unprecedented. And when it breaks, the move in gold will be unprecedented. This isn't about fear, it's about mathematics. When 40% of all dollars ever created were printed in the last 4 years, when global debt can never be repaid, when central banks are buying gold at the fastest pace in history, the outcome becomes inevitable. The question isn't whether gold reprices dramatically higher. The question is whether you'll be positioned when it happens. Because when that morning comes, when you see gold gapping up $1,000 overnight, it'll be too late. The unthinkable isn't just possible, it's probable. And the smart money isn't waiting to find out. The window is open now. But windows don't stay open forever, especially when what's on the other side is a complete restructuring of the global monetary system we've known our entire lives. Gold isn't just insurance anymore. It's a ticket to the other side of the reset. And that reset is coming faster than anyone wants to admit. If you want more deep market analysis like this, subscribe and stay close to the channel.